This is Matthew Cratter from Trade University, and today I want to talk about inflation, government lies, and your portfolio. I'll show you where we are on the clown world map for inflation. We're somewhere right here where inflation is called surprising by the Fed. Last year we talked about how people were pretending there was no inflation in spite of all the money printing. Inflation was low. Powell was saying inflation was transitory. We're on our way to them saying inflation is good, but right now we're kind of at this intermediate clown world stage. This was the article we covered back a couple months ago where Powell said that the recent rise in inflation was just transitory, meaning that was just going to be around for a short period of time and then disappear. Now that transitory has turned into frustrated in the last day. Yesterday, the chairman of the Federal Reserve, Jerome Powell, said that inflation is frustrating and it might actually run a little longer than people expected to, running into 2022. He also mentioned that, if we could scroll down here, that he believes it's the supply chain bottlenecks that are causing this. Now, this is what happens when you outsource all of your manufacturing to a country called China that might not have our best national interest in mind. You can imagine what would happen to inflation as the threat of China invading Taiwan goes up. So it's hard to see how these supply chain bottlenecks go away when there's a lot of geopolitical tensions at work. Meanwhile, we're seeing this trickle down to the consumer level, and there's a really kind of a sad but funny example. The Dollar Tree, whose whole brand is based on selling things for $1 or less, has now, because of so much inflation, they've had to change their pricing. They should probably change the name to the $2 Tree, but for now, they're just going to try to include more products that are priced at $1, $3, and $5. This is quite significant. This has, of course, happened over time. There's a chain of motels in the U.S. called Super 8 or Super 8 motels. They were called this because the original room cost was $8.88. Now probably 20 times that, or somewhere around that. So these changes have had to happen. We used to have the five. They used to call them the nickel stores or the 5-cent stores. This was well before my time, obviously. And then they had to change the name to 5 and dime stores because the value of the money went down 50%. This is your economy under central banking. We're seeing this affect rents as well, which will trickle down to the CPI numbers. The Dallas Fed now saying that even next year they see rents going up. Even into 2023, they see rents increasing at a rate of somewhere between 6 and 7%, which would be the highest rate in more than 30 years. So this is the Dallas Fed, a branch of the Federal Reserve, even saying this, that they are not seeing inflation as being transitory at all if it's extending out into 2023. But what's really going on here? What is this clown world game that is being played? Well, the Fed needs to keep playing these language games in order to keep the bond market happy, so the bond market doesn't panic. They can't come out and say the truth, which is we are going to massively debase the US dollar through money printing, through the Fed money printers, so that we can pay back all of you bondholders with depreciated funny money. They need to pretend to be concerned or pretend that inflation is just temporary or transitory or surprising, and of course it's going to go away the next day. We see this is really the master chart that I've been referring to in the last few days' videos. This looks at the total US debt, so federal government debt as a percentage of the GDP, so as a percentage of the size of the economy. And we're in a very different position, I have to keep emphasizing to people, than we were in the late 70s, early 80s, when the debt as a percentage of GDP was somewhere between 25 and 40%. Right now, we're at a much higher level. We're at about 125%. When the economy has this much debt in it, and this is just federal government debt, it doesn't take into account corporation debt and household debt and local government debt, county debt, etc. When you have debt levels this high, you simply cannot have high inflation rates. You cannot play the Paul Volcker playbook, which is to massively raise interest rates in order to stomp out inflation. In fact, the Fed actually wants inflation. They want to bring this ratio down from the high 130s all the way back down to, call it maybe 60% or so. This would be somewhere around where the average has been in the late 90s. This is especially important as well when federal government spending is such a huge percentage of GDP. Right now, it's somewhere around 31%, at least for the most recent data numbers. Again, this is money the federal government is spending to prop up the U.S. economy, and it doesn't have enough money in tax revenues. There's not enough money coming in to do this. And so we're in this weird situation where the government is such a huge percentage of GDP, and yet it needs to borrow money in order to keep spending. This is the real reason that inflation is not going to be transitory. And when Powell says that inflation is surprising, he's not surprised by it. He's running the money printing machines. So as we've said a couple times in the last week, the Fed cannot raise interest rates without blowing up the U.S. stock market and real estate market. When you have risk assets and you raise the discount rate by raising interest rates, it lowers asset prices, which would be devastating for government tax revenues. This would mean if government tax revenues fall because people aren't paid as much capital gains on their housing and their stocks, this would mean that the U.S. government would need to take on even more debt to pay its bills. And so this is really a catch-22. The Fed is between Scylla and Charybdis. Whenever interest rates start to rise, as they did this week, we saw the 10-year note rise from, call it around 130 to above 150 or 1.5%, 150 basis points. When this happened, the stock market, especially growth stocks and the FANG stocks, really took a hit, as did a lot of cryptocurrencies. So it's the government really cannot raise interest rates at all from these low levels, even all the way out the curve. The 10-year note the yield got to something like 15 or 16% back in the late 70s, early 80s when Paul Volcker was in charge. So we're basically at 1/10 of that, and even small ticks up in interest rates have a tendency to tank the stock market. We're in a very different situation from the late 70s. The government, the Fed, the central bank, they actually need inflation to stay here and run hot for a while. They'll pretend to be surprised, but this is all being done to bring down these ratios. They will let inflation run hot until the US dollar has lost a lot of its value, and as such, the nominal value of GDP has grown, and the US debt becomes much, much more serviceable. So how do you protect your portfolio from an extended period of inflation? And I think we're going to have inflation really for the next decade, certainly for the entire 2020s. This makes a lot of sense when you're at the end of the long-term debt cycle and you have the fourth turning and all of these cycles at play as well. Well, the primary way, and one of the focuses of this channel, has been talking about Bitcoin. This is really the purest hedge against fiat currency depreciation and devaluation. So I'll link to this video, Bitcoin for Beginners. It's about a year and a half old. You can also check out all of my other Bitcoin videos, which I make almost every day. The other way I like to protect my own savings from Fed debasement, from fiat currency debasement, is various long-term investments, which I make available to subscribers at Trader University Premium. I'm very proud of this one. This is a commodity play. It's an excellent hedge against inflation, and I'm especially proud of it because this is an investment that will make money, because the way it's structured, it will make money even if the underlying price of the commodity does not go up. Even if it stays constant or flat, this investment will still make money, and it's done quite well actually since June 8th. Of this year, when I released it to Trader University Premium subscribers, and I expect it to do tremendously well. The news about this commodity has gotten more and more bullish every week since I put this on, so I think this is a home run. There are a couple other plays in here. I have 2 options plays on Bitcoin that are various different ways of playing it. One is a more levered way, one is a more conservative way. I also have my favorite SPAC in long-term investment, number 1. And then finally, I have my latest stock pick in terms of long-term investment. And this is a company that will really benefit from the rise of the spying state in the US as we move more towards a Chinese system, a social credit score system, where the government monitors every aspect of your life. The way you protect yourself from this is Bitcoin, but there is a corporation that will disproportionately benefit from this move. And so that's what I talk about in long-term investment. Number 5, if you join Trader University Premium, you get access to not only all my long-term investments, my favorite momentum stocks, that list of stocks, but you also get unlimited access to all the courses. There are about 14 courses on the website right now. Momentum Stock Secrets is a great one. If you're just getting started, Learn to Trade Stocks Like a Pro will really take you from A to Z. There's a day trading course for those of you who have like shorter time horizons for trading. And then I have a course on how to make money with IPOs, how to trade options and use them to leverage your returns, also how to trade futures as well, and how to do swing trading with options, which has become one of my most popular courses. I also have a recent course that I've been working on, which goes into, it's not listed on this page, but it goes into Bitcoin in depth and helps you to understand how the protocol works. So if this is something that interests you, you can scroll all the way down to the bottom here, click Get It Now. Normally access to everything, my list of long-term investments, my inflation hedges, momentum stocks, etc. It's normally just $125 for 30 days access. But because you've been listening all the way to the end, I want to give you a special coupon code. You can click right here, have a coupon code, and type in YT, capital YT as in YouTube, 99. Click update, and they'll take $26 off. And so you'll get access to everything for 30 days for just $99. They'll get you access to all the courses as well as my long-term investments. And this is a really nice way of sort of following along with what I'm doing with my own portfolio as I seek to preserve and grow wealth in the face of a very hostile government and a very hostile Federal Reserve that will continue to lie about inflation for the remainder of the decade. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.